Let's go. Super excited about today's episode. Let's go. Super excited. Is there an echo in the building? All right. Come on in. Don't be shy. Okay, that's better. I like that. Analytics. Welcome back to Mission HQ unit. Vilmar Lara, the Sergeant of Real Estate. Tonight, we're going into boot camp. And we're talking about something that can make people uncomfortable very quickly. And that's credit. Some people avoid checking it. Some people avoid or are afraid of what's on it. Some people may have made mistakes in the past and think that those mistakes mean they can never become homeowners. Some people have good credit but don't understand what lenders are actually looking at. Tonight, we're going to change that. We're not here to judge your credit. We're only here to understand it. Because here's the military lesson. You can't improve what you're unwilling to inspect. So tonight, we're inspecting the situation. Cool? Again, before we start, I want to answer one question in the chat. Have you checked your credit in the last 90 days? Type in the chat yes, no, or I'm afraid to look. So let's switch it up over to affirmative, negative, or afraid to look. I'll start. Oh, absolutely. I have checked mine. We're going to go over myths. We're going to go over most of the basic information that it's not that complicated to acquire. DEFCON 2. No, we're still in DEFCON 4. Where were we? So have you checked your credit in the last 90 days? Cool? Affirmative, negative, or are you afraid to look? And if you pick the last one, which is you're afraid to look, you're exactly who needs to be here tonight, for sure. So let's start with the phases. Phase one, credit is intelligence. Let's keep it simple, okay? Credit report equals intelligence report. We're looking at accounts, we're looking at payment history, we're looking at balances, collections like public records, information where applicable. We're looking at errors and length, history of accounts. Important, um, important information. Lenders search for this information and acquire and require this information. I'll give you guys a military analogy. If I'm preparing for a mission and I don't know what's actually happening on the ground, I am going to be operating on assumptions. That's the same thing with credit. And we don't operate on assumptions. Neither should you. Neither should you. If you don't know what's on your report, you're operating blindly. If you don't know what's on your report, you're operating blindly. So we got chat going. What's the hardest part about credit for you? If anybody can answer that. What's the hardest part about credit for you? Is it understanding it, improving it, debt, past mistakes, or simply knowing where to start? What's the hardest part about credit for you? You guys can either type 1, 2, 3, 4, or 5. 1 is for what's the hardest part about credit for you. 1, understanding it. 2, improving it. 3, debt. 4, past mistakes. Or 5, simply knowing where to start. Put that in the chat. Go ahead, comment on the question above. I'll respond to it. And that was phase 1. Credit is intelligence. Let's do phase 2. What actually matters? Okay. I'm going to break down the major areas without overwhelming the viewer. And that's payment history. Why paying obligations on time matters. We're going to go over that. Debt. Explain that lenders evaluate existing obligations when determining affordability. I'll explain that too. Credit utilization. The basic concepts of credit utilization, turning it into a magic number formula, it's not how it works. It's credit utilization. We'll go over that as well. We'll also go over length and history. Why establishing credit matters. New credit inquiries. Definitely needed, but not during closing times. Constantly, I will explain why constantly applying for credit can create additional questions. And the last one is errors. Why viewing your report matters. Why viewing your report matters. So this is phase two, what actually matters. Payment history, debt, credit utilization, length and history, new credit inquiries, and errors. Type it in the chat if you have comments, questions, or concerns. We're doing good time. Stay with me, folks. In a few minutes, I'm going to give you my credit recon checklist. 5 things I want you checking before you ever sit down with a lender. So let's talk about briefly about red flag recons. Ignoring your credit completely. Number 1, red flag recon. Ignoring your credit completely. Don't do that. Red flag number 2. Making major financial moves without understanding how they could affect your mortgage plans. Red flag number 3. Assuming one credit score tells the entire story. Here's a big one. Red flag number 4. Paying a company because they promise a guarantee score increase. Red flag number 5. Waiting until you're ready to buy before checking your credit. Let's run into a scenario. We'll get back to this training here. So let's say someone tells me, "Hey, Sergeant, I'm I'm planning to buy next year, but I have some credit card debt and I don't know where my credit stands." What's the first thing you think I should tell them? Is it go get a report? Check your credit? Go talk to a lender? Pay off your debts, clear your credit cards, student loans, hold off on purchasing a vehicle, hold off on purchasing furniture. Or you guys can tell me, what would you do? Tell me what you would do. My guidance and expertise would be to reach out to a lender of mine that I trust and expect him or her to work as I work. The more you're informed, the better you make your decision. So, phase three, what if your credit isn't where you want it to be? This is huge. Phase three, what if your credit isn't where you want it to be? So, let's talk about, first of all, don't panic, don't hide from the problem, don't make random financial decisions because someone on social media told you to do so. Get accurate information. Let's build a realistic plan, just like the last episode, how to build their first time home buying battle plan. Work with qualified professionals when appropriate. And obviously, the most important one is give yourself some time. Anything worth having takes time. I didn't just build this setup overnight. It took me time. If you go into my uploaded videos, you can tell there's been a gradual increase over time. And pretty soon I'll make a video of my setup. I think that's also due. I'd like to do that. So, for instance, let's go back to phase three. What if your credit isn't where it's, where you wanted it to be? I'll give you a military connection, for instance. One bad day doesn't determine, when we're out on patrol, doesn't determine the outcome of the entire mission, right? Of course, we have more bad days than good days, but you assess, you adjust, you execute, and you reassess. Assess, adjust, execute, reassess. Reminding you that your credit score is information, it is not your identity. Your credit score is information, not your identity. Got to get that credit intel. All right, let's do phase four in a second, but right now let's do rapid myths. Credit myths with rapid fire. Pew, pew. I need perfect credit. You don't. Mortgage qualifications depends on the loan program and the complete borrower's profile. You don't need perfect credit. I've known of people with perfect credit. I don't have perfect credit. Myth number 2, checking my own credit ruins my score. We will go over that as well. There's a distinction between checking your own credit and certain lender credit applications. We will talk about hard pull and soft pull. But this is basic fundamental information. Subject matter experts like lenders know exactly what's on the report, and even then, some um, information still needs to be discovered. The next myth: if my credit isn't perfect, I shouldn't talk to anyone. This is why I'm doing this episode. Why early education can be extremely valuable. Yes, if your credit isn't perfect, you need to talk to a professional. Preferably licensed. There's a lot of misinformation out there. Do your research. The next myth: I should pay off everything immediately before buying a property, buying a home. The financial decision should be evaluated in the context of the entire mortgage plan rather than, blindly following generic advice. If somebody tells you you definitely need to clear it because that's what they needed to do to purchase a property, that was their particular situation. Every client, every individual has a different strategy, has a different outcome, has a different task, has a different mission. That's why you need to speak with professionals so you can create a battle plan and create a team to execute it accordingly. So if you guys have heard of any of these myths, which one of these have you heard before? You can type myth in the chat. And which one have you heard? You guys ready? Let's do the Sergeant Credit Recon Checklist. This should be my signature takeaway, so pay attention. Number 1, get your reports. Know what's exactly in them. Number 2, review the accounts. Do you recognize everything you see in there? Number 3, look for errors. Don't assume everything is correct on your report. It's imperative that you check, double check, triple check. Number 4, know your debt. Understand what you're paying and what you owe. Number 5, build your plan before you even apply. Don't wait until you're standing in front of a lender to discover surprises. Cool? Do we have roll call? Where are you watching me from? And are you active duty, veteran, civilian? Or just here to learn? Too easy, drill sergeant. That's right. That's correct. I am tracking. Cool. Do we have any comments, questions, or concerns at this time? All right, let's get to it then. So here we go. The three major credit bureaus are Equifax, Experian, and TransUnion. These three credit bureaus are independent companies that collect your financial history. They collect them from lenders. They create credit reports and calculate credit scores used by banks, landlords, and employers to check your financial trust. And remember, this is your information, it is not your identity. Equifax tracks consumer credit and offers identity monitoring services. Experian is a massive global agency recording data for over 1 billion people. And last but not least, TransUnion operates across the US and Canada to log credit histories. So, we're going to backtrack a little bit. We got the credit bureaus. Let's go back to phase 2. This is what actually matters. So the first one we went through was payment history. Payment history is the most important part of your credit score. It makes up 30% of FICO and up to 40% of your Vantage score. Lenders look at it to see if you pay your bills on time. This record tells them if you are safe to lend money to. This is why it matters. It's got one of the biggest score impacts on it, right? 30 to 40%. We'll keep tracking that. There's a little graph here. 30% owed, 10% new credit, 50% length of history, credit mix, payment history. So it's the biggest one, 35 to 40%. Then the next one is what you owe, 30% of the amounts that you owe. That's your score. And then new credit is on 10%, and then 15%. This is how much effective it is when it comes to your length of credit history. Payment history, huge. Phase number 2, what actually matters is debt. A client's existing debt is vital to a lender because it reveals their ability to repay a new loan. Lenders use a client's current financial obligations to measure risk, calculate the DTI, which is your debt to income ratio, and decide whether the borrower has enough leftover cash flow to handle a new monthly payment without defaulting. Lenders also require a 6-month reserves. Why does it matter? The repayment capacity. They want to see evidence that you're not going to default on the mortgage payment. It basically shows if the client earns enough money to cover all bills. Disclosure, 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 disclosure. Confidentiality, confidentiality, confidentiality. And accountability. It also shows the risk evaluation. High debt signals a higher chance the client might miss payments. DTIs, debt to income ratios, compare total monthly debt to gross income. Most lenders prefer the DTI below 43%. Again, this is basic information. Subject matter experts like lenders are the ones to speak about credit reports, and how to get ready for a purchase prior to, during, and after the purchase. Cool? Credit utilization. It is important because it makes up 30% of your FICO score. So that's why the sweet spot is to use your credit under 30%. It measures the amount of revolving credit you use compared to your total limit. Lenders use it to see if you manage money well or risk being overextended. It is imperative. If you're interested, I have a couple of tips and tricks how to start building credit. Comment, share, like, subscribe. Let me know if you're interested. I'd be more than happy to help. And it consists of a secure credit card. Let's go to length and history. The length of your credit history shows banks how long you have managed debt. It makes up 50% of your FICO score and roughly 20% of a Vantage score. Lenders prefer older accounts because they track long records. It proves that you can pay bills over the extended amount of years, right? Like you have stability, making you a safer borrower. So that's where I'm talking about with the first 2-3 episodes, where you need to have discipline. You need to be accountable. You need to make sure you do your research. You need to make sure you build a good team. You need to actually on Monday we should start the coin challenge. I've been talking about it, but I'm still running through the numbers to make that happen. And obviously we're trying to see if we can pick up more viewership. So once we pick up more viewership, I will start the coin challenge for sure. So oldest accounts, the age of your first active and property track line of credit, the time since you last opened a new card or loan for the newest accounts, and average new credit inquiries. This one is important. New credit inquiry happens when a lender checks your credit report. A hard inquiry occurs when you apply for a loan or credit card, which can lower your score by a few points. A soft inquiry happens when you check your own score or a company pre-approves you and it does not affect your score. Hard pull, which is what's the term known for, and soft pull. Hard pull, application for a new loan, credit cards. Soft pull, checking your own credit. Hard inquiries, apply for a credit card, mortgage, or loan, lowers your credit score by a small amount, usually 5 points or less. It stays on your credit report for 2 years, but only hurts your score for a few months. Let's see, grouping multiple auto, home, student loan applications in a short window, 14 to 45 days, often counts as just one inquiry. 45 days is the max day limit before you get hit with another record of it. Soft inquiries happen when you check your credit report or look for at free reports at annual report credit. It happens when lenders check your file for pre-approval or pre-qual. It offers or on background checks. It does not change or hurt your credit score at all. Are only visible to you, and you view your own report. So, yeah, I mean, it's just the difference between the hard pull and the soft pull. Again, subject matter experts, lenders. And then the last but not least, errors. Reviewing your credit report is actually crucial because errors can lower your credit score, cause a loan or job denials, and lead to higher interest rates. You can check your reports for free, but again, it's a soft pull to catch mistakes early, stop identity theft, and save money. The reason why it matters, and I've said this before on the previous episodes, better loan rates. Clean reports help you approve for loans, credit cards, and mortgages with best interest rates. Stop identity fraud, finding strange accounts on wrong personal data alerts you to identify theft early. Protect job and housing chances. Landlords and employers often look at your credit history before they rent to you or hire you. Avoid unfair cost, fixing false late payments. Stop your score from dropping by mistake. It's important. Payment history, debt, credit utilization, length and history, new credit inquiry, errors. Comments, questions, concerns. We already went over the credit recon checklist. The Sergeant's credit recon checklist. Number 1, get your reports. Number 2, review your accounts. Number 3, look for errors. Number 4, know your debt. Number 5, build your plan before you apply. Again, comments, questions, concerns. Indeed, happy Wednesday. So we got mission orders. Before Friday, your mission is simple. Don't change anything tonight just because you heard something on this stream. Inspect first. Understand what's there. Write down your own questions, then build your plan. If you have questions, put them down in the comments. I'd be happy to assist you or to refer you over to another professional. So build your battle plan. Comments, questions, concerns. Any questions about what I went over? Is there something you guys would like for me to go over? I'd be more than happy to. Because if not, then unit, that's credit boot camp. Tonight wasn't about having perfect credit. It was about having the courage to look at the situation and make a plan. Remember, your past financial mistakes don't have to become your future. Assess, adjust, and execute. That's how we approach every mission here at Mission HQ. If tonight helped you, subscribe and send this episode to somebody who's afraid to look at their credit. Friday, we're taking what we've learned and putting it into the real world. And we're talking about what happens when the real estate deal starts going sideways. And what separates a problem from a disaster. I've got a couple of those. Knock on wood. Haven't fall through. But it's meant to happen. It's just a matter of time. Again, I'm Vilmar Lara at Sergeant of Real Estate. Stay disciplined, stay prepared, complete the mission. Mission HQ is standing down. Sergeant of Real Estate at all social accounts. Over and out.